Bitcoin mining. How does it work? Is it still profitable? Bitcoin mining is the process by which new bitcoins are entered into circulation. It is also the way the network confirms new transactions and is a critical component of the blockchain ledger's maintenance and development. Mining is performed using sophisticated hardware that solves an extremely complex computational math problem. The first computer to find the solution to the problem receives the next block of bitcoins and the process begins again. Cryptocurrency mining is painstaking, costly, and only sporadically rewarding. Nonetheless, mining has a magnetic appeal for many investors who are interested in cryptocurrency because of the fact that miners receive rewards for their work with crypto tokens. This may be because entrepreneurial types see mining as pennies from heaven, like California gold prospectors in 1849. And if you are technologically inclined, why not do it? The Bitcoin reward that miners receive is an incentive that motivates people to assist in the primary purpose of mining, to legitimize and monitor Bitcoin transactions, ensuring their validity. Because many users all over the world share these responsibilities, Bitcoin is a decentralized cryptocurrency, or one that does not rely on any central authority like a central bank or government to oversee its regulation. Why Bitcoin needs miners? Blockchain mining is a metaphor for the computational work that nodes in the network undertake in hopes of earning new tokens. In reality, miners are essentially getting paid for their work as auditors. They are doing the work of verifying the legitimacy of Bitcoin transactions. This convention is meant to keep Bitcoin users honest and was conceived by Bitcoin's founder, Satoshi Nakamoto. By verifying transactions, miners are helping to prevent the double spending problem. Double spending is a scenario in which a Bitcoin owner illicitly spends the same Bitcoin twice. With physical currency, this isn't an issue. When you hand someone a $20 bill to buy a bottle of vodka, you no longer have it, so there's no danger you could use that same $20 bill to buy lotto tickets next door. Though counterfeit cash is possible, it is not exactly the same as literally spending the same dollar twice. With digital currency, however, as the Investopedia dictionary explains, there is a risk that the holder could make a copy of the digital token and send it to a merchant or another party while retaining the original. Let's say you had one legitimate $20 bill and one counterfeit of that same $20. If you were to try to spend both the real bill and the fake one, someone who took the trouble of looking at both of the bill's serial numbers would see that they were the same number, and thus one of them had to be false. What a blockchain miner does is analogous to that. They check transactions to make sure that users have not illegitimately tried to spend the same Bitcoin twice. This isn't a perfect analogy, we'll explain in more detail below. Is Bitcoin mining still profitable? There are several factors that determine whether Bitcoin mining is a profitable venture. These include the cost of electricity to power the mining machines, the availability and price of machines, and mining difficulty. Difficulty is measured in the hashes per second of the Bitcoin validation transaction. The hash rate measures the rate of solving the problem. The difficulty changes as more miners enter because the network is designed to produce a certain number of Bitcoins every 10 minutes. When more miners enter the market, the difficulty increases to ensure that the number of Bitcoins produced remains the same.